All right. Hi, everyone. I'm super excited for episode number 3 of the portfolio roasting format. Andrew is with us again. And I'm particularly excited about today's episode because the portfolio we will look at is, fairly simple in its structure, which we like to see. And I don't know, let's see how quickly we can get through it. The portfolio handed in today is from Charles, who's from the UK, living in London originally. He's from the north of England. He works as a teacher. He's 36. And he actually, that's his fun fact, used to be a semi-professional football player. His income, he earns around $5,000 a month, of which he contributes. So as he's based in the UK, everything is in British pounds. He invests around, what's that? A little more than 25% of it into his investing portfolio. And his savings rate, we talked about this last week, right? And his savings rate is actually higher because I think he's also paying off a mortgage, which we'll get to a little later. Right off the bat, what I will say is that he has a crazy high savings rate. So if you have a savings rate of 50%, respect. And well, it's not even a question whether you will do well financially over time, unless you, for whatever reason, increase your spending significantly. But if you can keep a savings rate, say above 20% for a long period of time, and he's relatively young, you will do well.
Yeah,
Andrew, anything?
Nothing more to add. I agree.
I will just add that you cannot see it on the slide here, but he also told me that he's basically establishing sort of a side hustle as a private tutor, which also gives him like an additional income of £1,000 per month. And I respect that. So he's young, he's probably full of energy. He uses the time to increase his earnings right now, to also increase the contributions he can make on a regular basis. And I respect that attitude a lot.
Okay, well then I have a question because so he has a side hustle giving him £1,000 a month, and then it says contributions to the investing portfolio would be £1,000 a month. So it is essentially all that money is what he's investing, and then he's investing nothing else out of that 50% savings rate.
Well, I think, and we'll get to
no critique there, but
yeah,
I was just curious.
He does pay off a mortgage. I don't know how much he has to contribute to that side of things regularly. Mm-hmm. He also said that the tutoring business is sort of cyclical, so it's certainly not a reliable £1,000 a month. I guess it just fluctuates. In terms of his investing background, so he started in 2018. I think he only started getting really into it in 2020, as a lot of people did, right? He sort of got interested in investing after reading about Buffett's investment in Apple. Like many, I think you and I fit into that category as well. He started watching Phil Towns content first of all, which I think is a great source to get started when it comes to value investing. I asked the people how did they feel, or how they felt when they initially started. And he wrote, when I first started, I was really interested in the subject and learning as much as possible. I consumed a lot of content and I have read a lot of investing books since I started out, which is of course great. Hasn't made any, at least so far, made any significant investing mistakes. At least he hasn't realized any significant losses so far. We'll get to how his individual positions have done a little bit later in the video. He has also been investing in Meta, which has been his most successful investment so far. Again, we'll take a look at how much he's up on that investment a little later. And as of today, he manages a portfolio of around $86,000 US. His goal is to be financially independent, as many of us aspire to become it at one point. And can also sense by just reading his comment here that he's also enjoying the process. The fact that you get in touch with people like you and I, Andrew, without the passion for value investing, we wouldn't be talking digital here across the pond, so to speak. So all of that is very inspiring, I hope, for other viewers. Because at the end of the day, at age 36, a portfolio of 86,000, that's definitely solid, I would say. I think that's he can be proud of where he's at right now in life.
Yeah, I agree.
Now we have to do some advertising again. We're actually running out of investment portfolios to look at. Actually, I talked to a friend a second ago and told him about the format, and he might be willing to share his portfolio. So we might have another one in 2 weeks' time. And if no one hands something in, Andrew, I think we'll just keep going, having a meeting every 2 weeks, and I'm sure we'll find topics to talk about. But if you want to give us a portfolio to look at, to quote unquote roast, we are happy to receive applications, and we're happy to look at almost any portfolio, I would say. If you just hand in or send in an email to the email you can see on screen right now. I do a lot of talking here. Andrew, do you want to do the disclaimer?
No.
I don't know what to do.
It's your YouTube channel. You get it right.
Fair enough. I mean, it's the obvious. We only want to create educational content here. We share our very own perspective on the portfolio we look at. And as I said, the main purpose of it is to entertain you guys. It's not to give financial advice. And if you are seeking financial advice, of course, you should seek out a professional who can help you make buy and sell decisions. That is by no means our intention with the videos we are creating here. And generally speaking, it's also always important to always do your own due diligence before buying or selling individual stocks. Then before we get into the portfolio side of things, I always also want to be very transparent about how we approach investing. So I try to repeat this in every single video of this format just because I think it's so important. We follow a value investing philosophy where we think of stocks as ownership pieces in businesses. We try to assign a value to these ownership pieces, and we're looking for basically discrepancies between what we think these pieces are worth and what they are trading for on public stock markets. And whenever there is a major gap between the two, well, we might want to use that inefficiency to either buy a stake in a company or maybe also to get rid of a stake we already own just because we believe, well, it's gotten ahead of itself in a way. And with that being said, we can take a look at the strategy that Charles handed in and how he described it. Basically, he is running a dual strategy because part of his income goes passively into an S&P 500 index fund, or it might have been an ETF, I don't remember right now. And then on top of that, he runs his active portfolio. I think we will watch a video of him in a second, and in it he shares that he expects and aims to have the S&P represent the majority of the portfolio. So he's definitely willing to have more exposure to his passive strategy, but he also enjoys the art of stock picking, as it seems like. Then he mentioned Chris Meyer as one of his, I guess, role models because he read his book 100 Beggars, which is a great book. I think that's if someone would ask me which maybe books I would recommend to someone starting out, it would be among the first 10 books I think you should read. Maybe not your first one, because I guess there's some terminology in there that's a little more advanced, but once you have a good understanding of the basics, I think it won't be particularly overwhelming either. Have you read it, Andrew?
I have. I've read it 2 or 3 times actually, but yeah, it's a great book.
Yeah, perfect. Which brings us to his question and worries, and actually we'll take a look at the video he handed in. So it seems like the viewers are really interested in boosting the quality here, because obviously if you're able to hand in a video, that makes it all the more personal, I would say. So let's just have a look at it.
Hi, Renee. So I wanted to just record a quick clip to give you my thoughts and questions around the portfolio. I started my investing journey around 2020, but had been interested in stocks since 2018. I am passively investing as one strategy into the S&P 500 and do that sort of on an automated basis every month. And hopefully eventually I would want the S&P 500 index to be my largest holding. The portfolio I would also like to be more equally weighted. At the moment it's not balanced. That wasn't my intention when I started out, but through going through the process, I feel like now I would prefer to have a more balanced portfolio. A sort of not a 10 by 10, but maybe 12 positions. I would also like to be able to not sell anything. So that would be another principle that I would like to stick to. I feel like it gives you an edge through just not selling anything, or at least committing to things for 20 to 30 year time horizons. I don't think I know at this stage which are my long-term compounders and winners, but in the nature of the Chris Mayer coffee can portfolio, I feel that maybe not knowing who my winners are, I would want to see like all the stocks run to see where they ended up. Yeah, I feel like probably the biggest question I have is probably around valuation, average price per share. I seem to at the moment be slightly at a loss with the portfolio. I think I got valuations wrong in a few of these positions. But I also always feel that, as Terry Smith says, with some good quality companies, it doesn't really matter when you bought them. As long as they weren't, ridiculously high in price, you could have bought them at many times and still done well. So I want to keep adding to this on an individual stock basis, balance the portfolio, continue to passively invest into the S&P 500. And yeah, so your opinions and thoughts, feel free to roast the portfolio. Thank you.
All right. Andrew, what do you think about the way Charles thinks about investing?
I'm excited for this one because out of this being our third roast, so to say, I would say his mindset, and nothing against the other two, like we've said before, many roads, right? So I would say his mindset, the way he's began his investment journey, the way he thinks about it, seems to be more aligned with us two, and certainly we'll see as we get into the portfolio. And it seems to be he's digging in the exact same mines that we've been digging in. So I'm excited to get into this one. I think he has very valid concerns. I have a few comments that I feel like once we get to the portfolio, I could certainly add in that might be beneficial to him. But it seems like I think I might have more to add in this episode than the past ones, because it seems he's following more of the same journey that I originally took. So I feel like what I might have to say might resonate with him more. So I'm excited.
Perfect. Yeah. I also have a few comments to make here. I think one thing that stood out and that he stressed a couple of times in this 2-minute clip was that he aims to run a sort of equally weighted portfolio, which I would say, like when you start off, I think that's an okay approach. I think having a 10 by 10, so 10 positions with a weight of 10% each, when you construct a portfolio from scratch, I think that's a valid approach to take. But over time, these positions will develop differently, right? And what I was sort of hearing is he would like to keep that balance between the different positions, which would, again, then force you to, trim positions, reallocate it.
Which contradicts what he wants to do with the coffee can. Exactly. Yep.
Yeah. So... and maybe just didn't express it in this video clip. He probably understands that if you do run a coffee can portfolio, some of the positions will be big winners, will be driving the majority of the performance of the portfolio. And the tough part is actually holding on to them. I think that's by far the most difficult part. If you look at a stock like Netflix, for example, the stock was probably owned by millions and millions and millions of investors, and it has compounded at incredible rates. But I wonder how many investors actually, let's say that held the stock in 2010, were able to hold it all the way until the early 2020s. I guess that's at least a single-digit percentage, I would say, if not lower.
I will say my personal experience too. It was easier, and this sounds counterintuitive perhaps, but it was easier to hold on to positions through the ups and not so much the downs, but I still find it easy to hold through the downs, but through the ups and the so-called overvaluations, it was actually easier to hold on to when my portfolio was smaller. And the reason for that was that I was able to add a significant form of cash flow, right? Add into my portfolio a significant amount. So that starter position that might be up 100% right now, I'm able to contribute almost the exact same cost basis as that one. So it was easier to hold on. Whereas now the money I save versus the size of my portfolio, if there's, you know, if I have a company that's up 100, 200%, and then there's a screaming buy that seems like it could be my next multi-bagger, I might be able to save maybe a fraction of a percent of my portfolio. So naturally, I have to sell a position, and it's a tough. I find it a tough place to be in right now, where if I want to do anything significant in my portfolio, I naturally have to sell something else. So there's constantly an opportunity cost being weighed. But it's a lot tougher, I feel like, now that my portfolio has grown than it was when I first started out, which I'm not sure if you've experienced the same. But that's definitely something that I've realized over the years.
Yeah, that's a very interesting point, and I can 100% resonate with that that sentiment. I wouldn't say I'm not quite there yet, because I was also able to sort of increase my income a little bit and increase my savings rate. We're actually moving. I haven't told you yet. We will be moving to a new apartment later this year, which will reduce my savings ability. So
Yeah.
it will certainly have an impact on what you're describing here. But you then more become sort of like a closed-end fund manager, right? Who has to work with the capital that is already invested.
Yeah, Ryan, it reminds me of the I'm really resonating with it now when Buffett has said, Buffett and Munger have said before, you know, back in the day, they had more ideas than they had money, so naturally they had to keep selling, whereas now they have more money than ideas. And you know, hopefully one day I'll be blessed to be in that position, but unfortunately not right now.
Yeah, what I will also find interesting to observe in terms of observing my own behavior will be, naturally, as your monthly contributions become smaller, the volatility of your investment portfolio relative to, say, your annual income will also become more significant, right? So you will get to a point where your portfolio might be down, say, over maybe 2 or 3 trading days, what you would be able to contribute over 1 year. And I guess that will certainly make the whole investing experience a little more challenging emotionally. I haven't experienced this so far. So there are probably people with different temperaments out there. And I hope that I can remain as rational as I am right now. But of course, this will have an impact, right? If you think about it this way, when you consider, oh, okay, I'm down 1 annual income, I'm sure this will affect a lot of people.
Yeah.
All right. So we will start taking a look at Charles' portfolio now. We'll start with an overview of his asset allocation. And as of today, around pretty much exactly 40.5% is allocated to individual stocks. Then he hasn't hit his goal so far. So the S&P only represents around 11% of his overall portfolio. And then he's also sitting on 48.6% in cash. I have a comment to make on cash, but maybe you want to do the same. So I'll let you go first.
I was actually getting ready for the next part, so you can go. You can go first.
Yeah,
I'm pulling up some ticker symbols and stock.
Yeah, but maybe hear me out here. 48% in cash. So let's just round it up to 50%. That's a significant cash position, and I would argue it's almost an attempt to time the market. As much as I, for example, respect Phil Town, I have learned a lot from him. So I don't really want to talk badly about him, but I feel like he has constantly stressed the fact that he has been sitting on a lot of cash waiting for a major decline. And I think he's stressed that for 6 to 7 years now. I think that approach has actually cost him a lot of money, because 50%, if like what I wanted to bring up is the way you made me think about cash positions recently, right? So I was sitting on 10% in cash, and I said, feels a bit weird to have more cash because I haven't been sitting on cash for quite some time. And then you said, well, think of it this way: if your opportunity cost is the S&P, and you allocate only 90% of your capital, sitting on 10% cash for 1 year will basically cost you 1% in portfolio performance. But if you get to 50%, it will cost you 5%, and that's
a big drag.
Yes.
Yeah.
And if you miss out on 5% in 1 year, catching up on that compounded can be quite tricky. It's definitely what's the opposite of head start?
Sets you back. A setback. Yeah.
It's definitely a setback that will be hard to overcome. So I don't know. Later, when we look at the individual positions, I will bring up that he's invested in a lot of very big, almost mega cap companies. And maybe he needs to start looking at smaller stocks as well, because I feel like at the size of his portfolio that he's managing right now, there should be or should have been plenty of opportunities over the last 2 years to get more exposure to the stock market.
Yeah. One thing that makes me think he might have, whether he knows it or not, maybe a market timing mindset too, is if you were to rewind the video and go back to the beginning where he said he wants to add during market drawdowns. He did not, and he's talking about individual companies. He's not talking about the S&P or anything. He's talking about individual companies that want to add during market drawdowns. Individual companies do their own thing. Yes, market drawdowns typically, bring everything down. A rising tide lifts all boats, and vice versa. However, even in bull markets, there are plenty of pockets of bear markets for certain equities. And, I'm not saying every single one will be a buy, of course, but I would say whether the market is at all-time highs or not, usually the market is at all-time highs. I would say to try and find investment opportunities. Also, just quickly, I want to say about the Philtown too. Philtown has a lot of cash, which is important for someone who maybe is following Philtown and is also sitting in a lot of cash, but he's implementing an option strategy, which I actually spent a lot of time learning about, and it's actually not as complicated as people make it sound. However, if you're still learning about individual stock investing, I would say don't even consider or think about learning about options yet. But he is earning a return, an annualized return on that cash by doing cash secured puts. So that's also something to consider, which if you're just sitting in cash and maybe it's in T-bills or something like that, you're not probably earning nearly as much of a return as someone like Philtown is on that cash. That's also something to keep in mind as well.
Yeah, good point. All right, I'm just going to show the viewer the geographical exposure of his portfolio. So we can see that the United States represents the majority of his portfolio, followed by China. And I will actually highlight that the position that is attributed to the Netherlands here, in a way, could also be considered a Chinese position. And if you think about it this way, he has like a 30%, like I'm sort of just guessing based on the pie chart here, like a 30, maybe a little more exposure to China, which is definitely a big China bet. Not saying anything against it. I think it's something that's quite unique and something that you probably don't see all too often in the current environment, and also considering the sentiment towards China.
And also peculiar being section, I would say, not early. I mean, he's definitely been doing it for a few years, but clearly still in the earlier stages of learning, if he's planning on doing this for a while. China is just an added layer of risk that I feel like you probably don't need to take on, especially with the opportunities that you've had in U.S. equities over the past couple of years. So that's just something to think about as well. But I have a comment on this when we do get down to the portfolio, because something jumps right off the pages at me about that. So
perfect. Yeah. Just to sort of wrap up the full picture here, I'm just going to show the sector exposure of his overall portfolio and the industry exposure. I think what we said in previous videos is that we don't place too much emphasis on all of these exposure analysis or analyses data points. We would rather see you placing most emphasis on just understanding the businesses you own, understanding valuation, and maybe for the most part understanding the quality or above average quality of the businesses you own, which you can certainly find above average businesses in maybe not all, but in almost all industries. So I think we highlighted this in previous videos. Now we get to the slide you've been waiting for, I guess, Andrew, the individual position. So we see that as of today, actually updated it today, his stock portfolio, so his individual stocks represent or are worth $35,000. It's 8 positions in total, and yeah, I'll just let you have a go at it. Maybe first of all, Andrew, in terms of the construction of the portfolio.
Yeah, right off the bat, the construction of the portfolio probably isn't too far off of mine and yours as far as position, number of holdings, and sizing as well. Difference, I would say, though, this being not insignificant to his liquid net worth, but a lot smaller than his overall total portfolio value that we were talking about. Once again, is it too diversified in my opinion for the portfolio size? Probably, but the overall position sizing and everything, I actually it's very similar to mine and yours. I would have to say.
Do you know how many stocks you own right now?
I think, well, other than the 2 little tracker positions that you know about, I want to say it's 8 as well.
Okay, I think I meant 11.
Yeah, it might be 7, but two make up 50% of my portfolio. So,
yeah. And just to make sure we don't forget about it later, let me just reveal that I also own 3 of the positions here, which would actually be the top 3. So I also own Meta Platforms, Alibaba, and Amazon. And I think you also own Meta Platforms, and that's about it, right?
I own Meta. Yeah, that's it of this.
Yeah,
and right around the same weighting as he does. So
yeah. I think we talked again in previous videos about that we would feel more comfortable being extremely concentrated early on in your investing journey. What I will say is I think that's definitely a good level of concentration we see here. And at the end of the day, I would also always recommend to construct a portfolio in such a way that you can sleep well at night. I think that's what it all comes down to at the end of the day. There is not the ideal way to construct a portfolio, or maybe there is, but the ideal way is a portfolio construction that allows you to just remain unemotional when the market is doing his things.
Yep. The only reason I say to maybe concentrate some more as well, especially when people are first starting out, and this is, hindsight bias, this is what I did, this is what really helped me anyway, was, the phrase, diamonds are made under pressure. I think you really, really learn about a specific company. You learn, and to use the Charlie Munger phrase of invert, always invert, you want to find out what works, what doesn't work, and what doesn't work, you want to invert that. And that way you avoid it moving forward, right? And so I think with I would reckon to say that he's going to learn more from his Meta, Alibaba, and Amazon position than he probably will from the rest of the portfolio combined, just because he has a significant amount more money in those companies, and therefore he will be following them probably a lot closer. That would be my guess anyway.
Yeah, good point. So let me just quickly stress here that if you do like what we are doing here, you can support us by hitting the subscribe button. Obviously, we also always appreciate it if you leave a comment, maybe leave some feedback, suggestions for future videos. And yeah, let's just have a conversation in the comments down below. And Charles in particular, we of course encourage you to clarify a few things that we just don't know and maybe get wrong in such a format. And now we'll take a look at the individual positions, maybe at a few thoughts that we might spontaneously have. What I said earlier, Andrew, is that I noticed that most of the names are like super large companies. So if we look at the market caps here, we have like 1.3 trillion, 200 billion, almost 2 trillion. 87 billion is one of the smaller ones here, actually. 170 billion. Then Alpha Meta, what is it called? Metallurgical? I have it on the next slide.
Yeah, it's. I believe is that the coal miner?
Yeah. It's actually right. That's actually by far the smallest one. But basically, except this one, all of the other ones trade at a market cap above 50 billion. Which again, there's nothing wrong about this. But I think it's helpful for an individual investor to at least also be open to owning smaller companies. Just because you might have an edge here, as many of the big institutional investors cannot fish in that pond.
Yep.
I'm not sure how you think about that. What I always keep bringing up is Robert Vinal. He had once a passage in one of his investing letters in which he said it was sort of titled, or there was a subheading, mega caps can be mispriced too, which I 100% agree with. I think yeah.
I think they're mispriced more frequently than people think, and maybe not every single one. It's not like they move in a, as aggressively as small caps or whatever, of course. But you have to realize the groupthink, the mentality on Wall Street, the leverage these funds use against these large cap companies. There's a lot more deals in big caps than I think people would lead you on to believe.
Yes. Well, I can actually bring up a data point here. When I do the consultation calls with people interested in my mentorship program, I always show them a couple of 52-week stock charts of random companies, and you will notice that there is a major discrepancy between the low and the high. And actually came across a data point the other day that highlighted the change from the low to high of the 10 largest companies in the US in specific years. So I think in 2016, it was like 50% for them as a group, the 10 largest companies, which arguably should be the most efficiently priced companies. I think in 2018 was a similar number. And then I don't remember the exact date, but I think 2022 it was even 90%. And I think that tells you something about the volatility that you will also witness in the biggest companies in the world.
Yeah. I think it actually gets more exaggerated too as these newer technologies come out. AI, there's a lot of computer, quantitative driven trading going on, and I actually think that causes more opportunity than less opportunity. I know there's a counter argument to that, but that has not been my experience anyway.
Yeah, I mean, the number of double-digit stock moves after, like minutes after an earnings report has been released, say over the last 2 or 3 years, has been pretty mind-blowing to me. And oftentimes this, say, 10% move will be reversed over the next half an hour, which, I don't know, shows you there are certainly also opportunities created by these algo-driven hunts, I guess.
Yeah. Yep.
Where should we start? Maybe we can talk about Meta. And again, it's also the largest position in both of our portfolios. And I think it has a similar weight. So I think as of today, Meta also represents around 31% of my portfolio. I think it's sort of similar for your portfolio.
Yeah, just under 30 for me. Yep.
What I will say, and I can show it on screen for the viewers, I think the average purchase price for Charles and Meta was a very attractive $270 a share. I don't know when he bought it, but he either bought it on the way down, which I think is great, or what I would have even more respect for is if he was able to buy that stake and increase that stake on the way up, because I think that's just mentally so challenging. I don't know, but I wanted to bring that up. So he certainly didn't buy, or maybe he did, but he didn't buy the majority of this position, say, when the sentiment was at an all-time low.
Yeah, unless he just happened to be buying right before the drop, and then maybe he was loading up at the lows, and that just happens to be his average. Yeah, we don't know the story behind it, but yeah, regardless, it's certainly a great entry price in hindsight, right?
Yeah, Andrew, maybe you can, and I'm going to challenge you here a little bit. Maybe you can give me like a 1-minute pitch on why Meta is, and I know 1 minute is tough, but why is Meta the largest position in your portfolio right now? And we too are certainly biased here, so I just want to be fully transparent about this, because obviously as owners and as investors who enjoyed a lot of sweet gains from that stock.
You know, if you want to give me a minute, right, and I can pull up actually the thesis I wrote up when I was buying Meta about. Well, I've been buying actually for about 7 years, but when I built the bulk of the portfolio, bulk of the position up, at the time I had a YouTube channel, so I wrote a small script for it, and I can read that to you in a minute here.
Yeah, take your time. I have a couple of comments to make here. So what I would encourage the viewer to do is to pull up the most recent Mark Zuckerberg podcast interview. He went to the Acquired event, which I don't remember where it took place. But it was like a big event with like multiple thousand of live guests. And I think in this around 1 hour conversation, it really becomes very apparent how ultra long-term focused Mark Zuckerberg as a CEO is. He brought up this one example that they sort of made a mistake, maybe going public a little too early because the company was in the transition to mobile, and they had to get the ad offering right and had to help advertisers develop formats that work in mobile too, because on desktop you always had, on the old blue Facebook app, had ads on the right hand side, if I remember correctly. And then all of a sudden you had to have more intrusive, that's the word I was looking for, intrusive ad formats right in the feed. And as a result, the stock of Meta got cut in half pretty much right after IPOing. And he said, well, 1.5 years, that's not too bad. And then he referred to another mistake he made in terms of how the public stance Meta was taking in terms of a couple of accusations the company was facing. And he referred to this as more of a 20-year mistake, because I would agree, and I will actually question you about this a little later here, Andrew, that for the most part of, say, the last 10 years, the sentiment towards Meta was pretty bad, I would say. And Zuckerberg highlighted that he believes it will still take a couple of years to have a more positive public perception of what Meta is actually contributing to the world. Have you found your document yet?
Yeah, I have, and I actually chose to use the one that was still while it was Facebook. That write-up was from 2018, I believe. But so I just. So this was actually the shareholder letter that I sent you at the beginning of this year. But I wrote so this is
we should clarify. I think you are referring to the letter that you are writing to your father, right? Because you
correct. Money? Yeah. So I do not. I don't actually hold my own fund, but I manage.
But once
some of my family's
summarize
money.
the thesis for owning certain positions, right?
Yeah, and then I do some role playing as if though I did manage my own fund. That way I have
awesome.
That way I have a track record. So, but anyway, yeah. So I said at over a quarter of our portfolio, which should be much more had I not sold for the sake of selling, a flaw I'm still working on, Meta is one of the best businesses in the world and one of the only big tech companies where the founder is still at the helm and hungrier than ever to innovate and reposition the business for the next decades to come. While this innovation of AI, the metaverse, AR, and VR come to fruition, we still get to enjoy a cash cow business with monopoly-like characteristics through Instagram and Facebook, and a bazooka of untapped monetization potential in WhatsApp and Threads with 2.8 billion and 140 million users respectively. On cost, we hold this business at around 13 times forward earnings. So that was pretty much my basic thesis for Meta.
When did you write that? At the end of last year?
Yeah, it was probably written a week before New Year. So right around that time, right around Christmas time. So
I'm not sure if I paid close enough attention, quite frankly, but I think you didn't have AI in that thesis, right?
I did write AI, but it wasn't in my thesis. I said, well,
what I would just want to ask you is, if you were to rewrite that thesis, I guess you would maybe add something here, right? In terms of Meta's AI capabilities. I don't know. I would add that.
I probably wouldn't, because it's not much different. The main thesis to me is still. I understand the upside, and you and I have had private discussions on this, but as of now, I can't. I don't know that world well enough to see what those cash flows would probably look like in the future. Which is why, I get the business, and then the upside is Mark Zuckerberg and his motivation is kind of the way I look at it. So yeah. But you
I'm
clearly have a different take.
Yeah, I'm super bullish on the role that Meta is going to play in the world of AI. I think it's hard to deny that AI will ultimately have a significant impact on the world economy. In what way is like super difficult to predict, but I think predicting that AI will transform a ton of industries in a significant way, I think that's not a tough prediction to make. And my understanding is that Meta will play a role in this world in some shape or form. It's hard to predict what role, but Meta will definitely be a beneficiary of this mega trend. Let me just put it this way.
Yeah.
And I don't want to make this like a Meta show. So let me just wrap up by asking one more question here. I was saying a second ago that I had the impression that for the most part of, say, the 2010s, Meta's public perception was very negative. I feel like, at least if I consider the time that I have owned Meta stock, which I think I also started my position in 2018, I think the sentiment has never been as favorable as it is right now, which in a way, as an investor, you always have to act counter-cyclically, right? So have you ever considered trimming your position, maybe just a little bit, maybe just for opportunity cost reasons, now that we're certainly trading at a sort of fair price, and with everyone that you don't hear much criticism regarding Meta right now, right?
No. What I will say is every share of Meta that I have sold has been a mistake. And I have sold typically, and I know I was kind of being facetious and critical of myself, saying, sold for the sake of selling. It wasn't actually just for the sake of selling. It was an opportunity cost. Once again, I have more ideas than I have capital, so I had to sell. Meta rebounded, and I don't know, maybe I rolled that money into PayPal or something like that. But in hindsight, even though I thought I had a better idea, Meta, in retrospect, ended up working out better than that idea. So right now, even if it were to revert back to maybe a lower multiple or something, it's tough for me to sell that company right now. I think it's at a size where I don't want it any lower, especially to find a company of that quality with a founder with that track record and this much hunger and motivation to keep driving the company. I think you don't get that opportunity very often, and with the cost basis and everything that I have, it just wouldn't make sense for me to sell. It wouldn't make sense for me to take money from my first idea to put it into my sixth best idea, right? Which is still a flaw that I have, of course, because I'm always constantly thinking of opportunity cost, and it's a constant struggle that I have between weighing out cheaper companies versus better companies that I hold. It's not easy. No,
it's not easy. No, and you will get things wrong. That's just part of the hobby, the discipline.
Yeah.
I don't know. Maybe we should go one step back here, just for a second, because we didn't really talk about the portfolio as a whole. We already jumped into the discussion of individual companies.
Yeah.
What I would say is, again, just judging by the quality, and we have a hard time here talking about valuation, because valuation itself it can be complex, or it would require a more nuanced discussion of the individual names. But just looking at the names as they are in terms of their business quality, I think we are looking at a high quality portfolio here, with maybe one exception, which would be the commodity business, so Alpha Metallurgical. But besides that, we are looking at a good company portfolio, I would say. What do you think?
I agree. Two things stand out to me. The first being, he obviously, I would say, number one, based on his cost basis for Alibaba, that coupled with the Prosus and Alpha Metallurgic investment, I think it's very clear to me that he does the Monish Pabrai copycat investment, and also in copying Monish Pabrai. I think that's pretty evident. That jumps off the page to me. And which isn't bad.
Just to be clear, because Pabrai, I think he owned Brookfield. I think he no longer does, right?
Yeah.
Right?
Oh, that one too.
And he also owns the Alpha Metallurgical position, which I think Guy Spear also copied, even though it's just a tiny stock in his portfolio. I think. Please double check, but I think.
And I believe Li Lu owns it as well, which is typically Li Lu and Monish.
And Pabrai has been super bullish on Tencent. And I will reveal that a little later, but Prosus is basically a way to get exposure to Tencent.
Yeah. So, which is fine. There's nothing wrong with that, but I will say from my experience, and maybe Renee is a little bit different in this, but for my experience, copycatting just for the sake, and even if I convince myself, oh well, you know what, it seems like a great investment idea, and I can understand the thesis to it. Broadly speaking, I can understand the thesis, and oh, it looks cheap enough, I invest. I have never been comfortable holding those companies just because someone else holds those companies. I have always found that I need to just stay in my own lane and hold my own equities. Now maybe you're different, right? Maybe you do sleep better at night because a super investor
I agree.
But
that has also been my perception, I would say.
Yeah. Well, when I say you, I was actually more so talking to Charles.
Oh, yeah.
Yeah. So maybe he does sleep better at night. That is not my experience. Like, even if Warren Buffett were to hold a company, certainly makes you feel better. But if that was the sole reason for me holding a company, like, I couldn't go out and invest in Occidental Petroleum, even though it was clear that he was going to continue to keep acquiring a larger and larger stake in the company. It's just not something I'd be comfortable holding myself. So that's just something that I would say,
and I would say that is generally true, I would say. And there's this saying, and I won't get it 100% right, but that goes like, you can copy an idea, but you cannot sort of copy or steal conviction. That is something you have to develop yourself. And I would say that's, broadly speaking, true for everyone. And your conviction will be tested if the stock ever goes into a downturn. That's when you will get nervous if you don't understand what you own.
Yep. And when you do this long enough, and this is my personal experience anyway, I cannot explain and I cannot try teaching the feeling that you get, but there's a drastic difference between when that you feel that you're right about a company and when you feel like you're on edge. When the company goes down and you acquire more, you think you're real confident, but then you kind of want to sell for a profit on the way up just to kind of exit that position. You probably shouldn't own it to begin with. Whereas when and you're like, everyone else, like, you can't, you're almost questioning if everyone else is crazy or if you're crazy, because you're like, I don't see it. And you continue to just sleep well at night. You'll really, really know. And those opportunities do not come that often. I will also add, those are very few and far in between. Also, one other thing, Renee, I know I keep
let me just say that I think you did a wonderful job describing that feeling. I think many people will be able to relate.
I hope so. And then the last thing I just wanted to really talk about, and then I'll pass it off to you, is he says he wants to. We kind of talked about the contradiction, right? He wants to do the 100-bagger portfolio, kind of coffee can, never wants to sell, which is great. That's admirable. Nothing wrong with that. But then he also says he wants to keep equal weight, right? Maybe he meant equal weight on cost. Certainly that might make sense, right? There's nothing wrong with that. One thing, looking at the portfolio, number one, if you're doing a copycat investment, but then also, for example, the alpha that, or something like a Walt Disney, maybe that's a valuation play, right? I'm not sure, but if these are valuation plays, and Renee, you and I have discussed this before, you have more of a long-term compounder mindset naturally. I struggle between buying these compounders and then buying something cheap as a valuation play, which is nothing wrong with, but you need to know, if it's a valuation play, you need to know that you're going to have to sell eventually, right? And the reason being is the inherent return on capital, that growth engine within the business. Over the long term, the longer you hold an equity, the more that growth matters. Whereas the shorter that you hold an equity, the more that multiple re-rating up or down matters. So something maybe like Alpha, whatever that company is, maybe that's a valuation play. I'm not sure, but I would say you're probably going to want to sell that. Whereas something like a Disney too, you have to think longer term. I mean, maybe grow 6 or 7%. I'm not sure, but if you're really looking if you were buying it because it was cheap, that's fine. I have no opinion either way on that, but that makes sense. But you're probably going to want to have to sell that because I feel like its best growth days are behind it. Maybe he has a different investment thesis to it. I'm not sure, but if you're looking to hold a company of that size, like Walt Disney for the long term, I don't know. What are you really going to get better returns than the overall market? I'm not too sure, but that's something he would have to assess himself.
You plan to hold Meta, which is $1 trillion company, for the long term.
Yeah, but if you think so, this is also something, right? Everyone thinks $1 trillion. Oh my God, that's crazy. When I first started investing, there wasn't even a single $1 trillion company. Now we have over $3 trillion companies. If you look just 10 years ago, I think this is human nature. It's tough to understand how large the global economy can actually grow to. But like if you think maybe 15, 20 years ago, I don't know the number off the back offhand right now, but I wouldn't be shocked. When was the last time where no company, put it this way, when was the last time no company was over $100 billion? It was probably 20, 30 years ago. That's kind of crazy to think that the largest company has what 10 times 30x since then.
Yep.
So I mean, I think there will probably be, especially as these certain opportunities show themselves. It seems crazy to think that Meta can probably keep compounding, and I'm not saying they're going to compound 20-30% per year, but probably better than the overall market, plus the multiple re-rating that I've had over the couple past years. That I can pencil out a market beating return for, and same thing with my number 2 holding. The bottom half of my portfolio, I haven't been able to pencil that out yet. So that's all.
Perfect. I think those were a lot of interesting takes. So thanks for sharing that. Let me just see. I don't want to go through all of the positions. I mean, Amazon is clearly a high quality company. Made a couple of headlines this week with their back to office policy decision. Both you and I don't work in office jobs, so I don't think we have anything meaningful to add here. The one company I wanted to briefly bring up here is Prosus, but because I think that's an interesting name to have in your portfolio, and I would say that's, unlike many of the other names, a company that is not particularly popular right now, and as I said, that you won't find in many investors' portfolios. So I kind of like that approach of being willing to own something that is not popular right now, because China is certainly not popular, but China deserves its discussion on its own. But basically the thesis here is Prosus is basically giving you exposure to Tencent at a discount, because I think Prosus owns around, I'm not sure if that number is up to date, but let's just say around 30% in Tencent. And interestingly, the stake in Tencent alone is worth more, if we look at Tencent's current market cap, than Prosus' current market cap. So there's a discount to net asset value. That's how you would refer to it. And what I found interesting, Andrew, is that on the investor relations website of Prosus, they actually calculate the net asset value on a daily basis for you, which I have never seen any investor relations team do for, say, another holding company. Maybe I'm sure you will find something similar, but I've never encountered it. And that already sort of shows me that management understands valuation and is thinking about valuation. That is something I like to see. So what you can see here, they actually calculate the net asset value on a per share basis, which is $53. I think the share price, because it's listed in Amsterdam right now, is around 30. Oh no, it's euros. Sorry, my bad. Euros. I think the share price is in the low 30s. So it's definitely like a play on that discount closing over time. And I wanted to bring up another thing here. I'm not sure if you are aware of it. Was actually, I actually studied Prosus maybe 2 or 3 years ago when Robert Vinal pitched it in one of his letters. And I was reading these passages again before the call today. And back then, the management team of Prosus did something interesting. So they have decided to, and I'm not sure if they still do it, but back then they decided to sell their Tencent shares over time, or trim it over time, and use the liquidity gained from those sales to buy back their own stock, which is trading at a discount to what Tencent is worth, if we now simplify things. And that is just something I love to see when management is thinking about creative ways of creating shareholder value. That doesn't mean I would want to invest in Prosus here, but I do find it an interesting company. I still own a tiny fraction of Alibaba. I'm not really looking to get more exposure to China, especially as long as there are other opportunities in, say, more democratic countries around the world. But nonetheless, I find that an interesting pick. What do you think?
Yeah, and I've always understood the.
Have you ever looked at
Naspers? Oh yeah, very deeply. Very deep.
Oh, okay.
Both of them, Naspers, Prosus, and Tencent itself. I used to hold Tencent, as well as Alibaba. But once again, this could probably be a conversation for another episode.
Yeah.
But my issue with why I never invested, Andrew Brown actually, I believe at one point was investing or thinking about investing, and I remember the conversation I was having with him was, I just don't see the appeal to me of added difficulty or just more confusion or more things that could go wrong, because now not only do I have to worry about Tencent and their management team and their business, I also now have to worry about this investment and this management team and how they're going to close this gap. And what if they just randomly decide to sell that entire, like it was added layer of just something to monitor that I think we've talked about in my very first interview on this channel with you, about how I just like to really keep things as simple as possible. And I think it was just, it was just too much work for me and too much confusion that, quite frankly, I didn't need, because there were other investment opportunities out there anyway.
Yeah.
But if you gave me the option, I actually would have picked Tencent over Prosus, regardless of the discount to their Tencent holding, just because it was a added layer of confusion that I did not want.
Interesting. I would pick Prosus any day of the week, but that would be a separate discussion. Let me maybe wrap up the Prosus discussion here by making a general comment. So you will quite frequently in markets find opportunities where you have sort of a holding company that is trading at a discount to its net asset value. That is something you will almost naturally see. And I would argue that, say, a 10 to 20% discount is something you will commonly encounter. That should probably be considered normal. Larger discounts, up to 50% or more, may be more interesting. But I think it is always important to think about, is management actually willing to do something about closing that discount? And apparently Prosus is aware of that discount. And the way I understand why Prosus has become a public company is also that Naspers management team has faced a similar problem. So that company was also trading at a big discount to net asset value. And to close that gap, they actually spun out Prosus. So the point I want to make is that these discount to net asset value plays, I think, have a place in value investors' portfolios, but only if you understand that management is willing to do something about closing that gap eventually. Let me just pull up the portfolio again. Is there anything else we should address? I don't have much to add here. I'm not sure about you. I apparently picked the wrong alphabet stock because it shows the Swiss flag next to it. But
yeah, I noticed that. I wasn't sure if he invested in that or if that was just something that you messed up on. Oh, okay. I was don't know, wondering why.
I don't know if there's a Swiss listing. I asked the people who hand in their portfolio to share the ISIN number of the securities they own, and may actually be correct. I don't know. Maybe it's a mistake on Koifin's end, but I don't think so.
User error. Way to go.
Say it again.
I said user error. Way to go, Renee.
Yeah, probably in user error. Let's maybe conclude things here. So I have one more slide, and you sort of brought it up, and that shows the average cost basis of Charles relative to the current price. And as I said earlier, valuation is something that would probably deserve its own discussion, and we will have a hard time assessing whether those were good purchases or not, especially for the companies that we don't know all too much about. I think we brought up valuation and whether the purchase price was reasonable with regard to Meta Platforms and Alibaba, and I think that's probably enough for a video in this format. How would you sum up our analysis here?
I don't know. I think you're asking to rate ourselves, or
no.
What do you mean?
No. What's your final take on Charles' portfolio and maybe his investing journey?
No, I think it was great. I think he's like I said, it reminds me very much of perhaps not everything specifically, but very similar to myself maybe 6 years ago or something. So I certainly think he's on the right path.
In the sense of copying things?
Just based on what's in his portfolio, seems to be he's fishing in the same ponds that I probably would have been fishing in, talking about the fill town, the concentration, the kind of the asset allocation of his portfolio. Yeah, I don't have much else to add. I think I've added most of the tidbits that I wanted to say already.
Yeah. The only things I would just repeat here again to wrap things up to help Charles maybe to consider what to work on going forward would be two things. Maybe consider also smaller companies. Doesn't mean you cannot invest in big companies. That's completely fair. But considering his cash position, I think he might have to look a little harder to find ideas to be able to reduce that cash position over time. And then I had a second comment to make. Let me just. Oh yeah, it was regarding valuation. I think that is something most investors can continuously work on. Maybe Charles can share how he goes about valuation in the comments down below. But I also had the impression that maybe he is sometimes, and again, we are speculating here, but that he's sometimes just copying ideas without doing the evaluation work himself independently. So I guess that is also something.
That's my hunch as to what's probably going on for the most part.
Okay, let's wrap things up. Andrew, thanks for your time, and we'll talk soon.
All right, take care.